whenever you have a VIP guest, you always have to say, we're honored to have the guest show up. So like, no shit. Like, we're really honored to have this guest show up, okay? No.
The concern was all driven by having to get from Glasgow early this morning and make sure I actually woke up.
Yeah, I didn't want to pay attention to his travel plans because it would stress me out. So we just accepted that he was going to be here. So we're going to just kind of jump right in. This is Jim Barry. Jim is one of the senior most executives at Blackrock. Many of you all are probably aware of the fact, although I get confused sometimes with black this and silver that and all the other things that are happening in the private equity world, and that's kind of my job to kind of pay attention to those things. But it grabs my attention when I see that a company like a Blackrock is rumored to be the largest asset manager in the world with over $10 trillion of assets under management in some form or another. As I've gotten to know Jim and gotten to know his excellent team, I've found out that they're into everything. Like, they're doing some incredible stuff to make the world better around infrastructure, ESG, climate change, and so forth. So I'm going to turn it over and ask Jim to start with the story of Jim Barry, and then we're going to drop right into what's it all about with Blackrock, and then we're going to go right into climate tech and some of the new initiatives that we're going to talk about here. Where we're going to end up is we're going to talk about, hey, what does this mean for the corporates? Like, what does this mean for the people in this room? And how does Blackrock want to interact with folks like you all? So we're going to get it started, but like, we're going to first open it up with Jim, born in a log cabin in Illinois. No. Go ahead.
A little shed on a hilltop in Cork in Ireland. That's the first thing you need to know about me. I'm from Cork, not Dublin, okay, in Ireland. It's a very clear distinction, certainly in my mind. The funny thing about Blackrock, Blackstone, etc., Blackrock did start in Blackstone's office. So Larry Fink was given an office by Steve Schwarzman, set the business up in '87. And as they, after a few years of coexistence, extracted each other, themselves from each other, Larry persuaded Steve to let him keep the Black moniker on the basis that we'd be forever associated with them. Steve regrets that, apparently, as the rumor has it.
Yeah.
The other little anecdote on that, given we're here in London, we have a lovely office over off London Wall. When that was opened by George Osborne, Chancellor of the Exchequer, about 8 or 9 years ago now, he did welcome everyone to the opening of Blackstone's London office. But anyway, so you're not the only one. We'll spend 30 seconds on myself. So I am Irish. I grew up in Cork in Ireland. I was a jack of all trades, mainly here in London, banking and consulting, and did an MBA in the States. But went back to Ireland in '98 with the first 2 or 4 kids at that stage, and met a man who owned 2 toll bridges, you know, the old story. And so got into infrastructure, and one of the first investments we made after I joined in '98 was in renewables. And so that's what first got me exposed to the whole climate dynamic. And I've got, you know, I love the way everything that happened in the early 2000s now reframed as Clean Tech 1.0. That was a time that had some of the promise that we now have no choice but to address. But it was far more turbulent, and in a sense, the policy context and the corporate context for a lot of the innovation wasn't there. And so there was a lot of money lost in the venture and growth phase. And I have a few of those scars, which I'm happy to share later with people if they'd like. But I think, 11 years ago, the company I was CEO of, we formed a partnership with Blackrock to set up the infrastructure business, starting with renewable power equity of about 10 billion today. And as part of the deal, Blackrock got me, and I guess that's been a great journey. We've built a phenomenal infrastructure business, but more generally, it's just under 10. It's about 9.5 trillion at the moment. But the alternative asset business of Blackrock is about 320 billion. Liquid credit, private equity, infrastructure, real estate, some hedge funds. So it's a big business, number 5 by scale, but it's an area of real focus for the firm because that's what clients want to allocate to. And as we now deal with the dynamics around sustainability in a general way and climate in a very specific way, kind of alternatives, and particularly the private market dimension, has a key role to play in the mix. BlackRock, just more generally, in defense of large asset managers, I will tell you, capital has an enormous role to play in what we're trying to achieve over the next 30 years. And it has to do it because policy is going to struggle, okay? And we're seeing that this week in Glasgow. But capital is moving, and it's moving with real momentum. And I would say to you, the challenge is actually to have places for it to go.
Right. That's right.
And that again plays to this world. It's as the leading asset manager, Larry Fink has, with a view that this is a fiduciary issue, this is climate risk, is a financial risk, has very much gone out there and taken a lead. And I think that BlackRock is looking to provide our clients with answers around how to play into this, but also to sort of work with corporations as well. So why don't I pause there, but hopefully that's a bit of an intro.
Perfect. Yeah. So I think one of the things that I've enjoyed about getting to know Jim is that, and many of you guys know that back in the day, starting in 2003, I helped originate and run the clean tech practice at Foundation Capital. Foundation's $4 billion under management. So it's kind of hard to say that with Jim here. I feel like a little tiny person when we say that. But $4 billion under management for a venture firm is pretty good. We've turned it into $500 billion, so that's really good. So from that perspective, when early stage venture works, it works really, really well. But when we went through our evolution back then, we spent 2 years calling it next generation industrial, right? Because we just thought that was like more appropriate kind of label. And then the rest of the industry forced us into adopting clean tech because that's what went on. We ended up deploying about $250 million. We originated Silver Spring Networks, we originated Sunrun, Azure Power, and some other things. But then we got our shirt handed to us. We just got killed in the Great Recession and in the collapse of the hype cycle associated with Clean Tech 1.0. So I'm glad you kind of brought this point up because now I think my observation, which I want to get your reaction to, is that we're seeing really two phenomena. We're seeing the classic recovery of the hype cycle, and the brain dead simple example is Tesla, right? So it was around back then, and then just kind of roared back, and then it's pulling a whole bunch of other properties with it that are kind of broadly in ESG and in climate tech. So one, we're seeing that, and then now we're seeing Clean Tech 2.0. We're seeing in what we call Environment 2.0. We do a lot of work around that with clients, many of them that are here in the room. And so as we see these two sort of positive factors emerging, you touched on one of the issues, right? There's a dearth of opportunities, right? I mean, we got, by the end of the Clean Tech 1.0 era, we had a massive over allocation or over, sort of population of opportunities to invest in, and the capital couldn't catch up. And now we're so far out of our skis with the capital first, and then now we've got entrepreneurs. I mentioned to Jim that our daughter, Kylie, is a senior at Stanford. She's going to be in the first class of a new major called Sustainability Science to get her master's next year, right? So the inventory of people assets is going to eventually catch up, but we're in this like little valley right here now. So how do you factor that in? Like what do you do? Because you're in a very sophisticated seat in this whole economy around climate tech.
So the first thing, the huge change between now and 20 years ago is we have to change. I mean, it's just, it just has to happen. And it has to happen in a really short time frame. And I think that most people are getting their head around the scale of transition required. Very few people get the pace point. Because even transforming our world to net zero, let's use that label, by 2050 plus or minus, is just the most extraordinary transformation of the global economic system that's ever been attempted. Right. And so, and the interesting thing is, and I know I'm talking to a corporate world, the classic corporate reaction to change, particularly when it's going to be driven, when regulation and policy are going to drive a lot of it, is to resist it, slow it down, delay it. That's the completely wrong corporate response today, because delaying is not going to change the fact we have to make the change in this defined time frame. It's coming. So delaying it only going to make the transition more expensive and more volatile for incumbents, for want of a better description. And I think that that's playing into the mix. And I think that as we think about where to deploy capital, it's a landscape that's changing every week, every month, every year. And so, so it's one has to be really thoughtful and careful because, your demand, for want of a better description, is shaped not by consumer. Like if you think about sort of classic venturing Silicon Valley, whether it's a business or whether it's the consumer, its demand is driving ultimately the revenue model. That's right. The revenue model in this world is going to be far more sort of inconsistent, exactly. I think the way I would say it. And so that classic instinct around venture and growth isn't necessarily going to work out in this space. And for those of us that lived the late 2000s through the global financial crisis, we saw that. And we also have to understand, I mean, if you see where we are today with things like wind and solar, right? Cheapest chips, frankly, even before you take the cost of carbon into account, the cheapest option in a lot of places. Clearly, there's a cost of balancing the grid. That's a whole other we don't need to dive into. But that's only there because of the tens of billions of subsidies that were spent by Spain and Germany, that the Chinese put into the manufacturing of solar PV. It was a 30-year industrial strategy of Denmark and wind. It just didn't happen by accident. And so as we look to sort of deal with the more difficult issues now, because we will drive efficiency and there'll be huge opportunities to drive efficiency, we will, electrify mobility, okay, in substance. And then we will decarbonize power generation. We'll actually electrify anything we can, and then we'll decarbonize. All that you can kind of get. But there's steel, there's cement, there's more large-scale transport, there's aviation. We have so many there's so many difficult things that will require some big solutions like hydrogen or whatever it may be. And I think that path is going to be very challenging and difficult. And if we don't get policy implemented in a cohesive way, it's going to be very hard, is the short answer.
Yeah, so I totally get that, and having lived the dream of some of the collapses of our businesses that we thought were really good businesses in sort of the 08, 09 timeframe, from that perspective, I understand the point behind it. So I'm going to switch to the fact that you all are already being very proactive about working on creating some new vehicles to go solve some of these problems, things like decarbonization partners, things like that. Can you just give us a glimpse into some of the thoughts you have there?
So look, about 3 years ago, so Larry Fink writes a letter every year. He started during the global financial crisis to the CEOs of corporations that we hold shares in, which is pretty much every corporation. He basically is always been very big on purpose. Right. That then brought him to sustainability in a sort of a broader sense of companies and their roles in society, which then brought him to climate over the last few years. Our clients are shifting capital. It's not all even. So European institutions are way ahead of, let's call it, southern state pension funds in the United States. That's right. Canadians, Asians are somewhere in the middle. But it's moving and it's relentless. And so what we are trying to do in that mix is shape product across everything from index ETFs through all the active fixed income and equities into my world of private markets, shape products that meet the objectives that clients now want. Now, really important, very few clients are saying, I want less financial return in order to have something sustainable, or I want to invest in climate, but I'm happy to do it at a discount. That's not where the money's at. And if you think about pension funds or insurance companies, they've got their own fiduciary obligations in a way that's hard to do. And so what we are trying to do more than anything else is drive the analytics and source the data that gives the empirical evidence that when you look at a series of ESG criteria, it's really pricing, it's categorizing a risk that is either priced today, which we're very good at evaluating and underwriting, or it's pricing a risk that will come in the future, medium and long term, which we are really bad at doing. And I think that's where we're coming at it from, and then consequently we're shaping product. Now we're also doing stuff very specifically around climate, which is looking to get at some of the more difficult issues. So Decarbonization Partners, you mentioned, which is a partnership with Temasek, is around growth equity, Series B, Series C, around decarbonization in its broadest sense, whether that's new technologies, new business models, new services, new information data, whatever it may be. But we just announced this week, we closed $673 million into a product called Climate Finance Partnership, which was in partnership with the German, French, and Japanese governments, where they and a number of endowments are providing 20% of the capital as first loss capital, and to allow institutional capital in behind to allow us deploy it in emerging markets. Because it's a whole other conversation, but non-OECD, ex-China is 47% of the emission challenge. We're going to have to transfer trillions of dollars to those countries and markets over the course of the next 20 and 30 years. And we've got to find models for doing that because the classic institutional capital does not want to be near the risk profile you're going to get in those markets. So very specifically looking to sort of crack the code, for want of a better description, on new models of deployment against some of the more difficult challenges in decarbonization.
Fantastic. I mean, it's so awesome for us to hear this from you because you're like right out on the forefront and you've got a very big stick that you're carrying out into the market to be able to do this, and it's well beyond the resources of all of us here in the room. I'm going to make this my last question, but it's a very important one, I think, for the group here, is that, as I've met with your team, with Teresa and Peter and some of the other folks who are outstanding, it's refreshing for me and maybe a little surprising, but I probably shouldn't be surprised, is how open you are and how interested you are in outreach to corporates, right? To forming these relationships, understanding where people are, where these investments are happening. We have many of our friends here in the room, with companies like Baker Hughes and Airbus and Stanley Black & Decker and BAT, Coca-Cola, Rolls-Royce, all of these folks, literally every single one of them, are trying to figure out a strategy and building strategies around climate tech in some form or another, either down to the incredible depth that we're doing at Baker Hughes with green hydrogen, all the way up to how does Coca-Cola really sort of maximize their opportunity in the marketplace from that perspective and also make an impact. So how would you have people think about you guys as BlackRock as a partner, and how should they think about relationships and engagement that'll benefit both parties?
Yeah, no, it's a great question. So BlackRock, by its very nature, has a relationship with every pretty much listed company through its stewardship role. Yep. It's distinct and separate from what we do day to day, but just to acknowledge that exists. And through that, we are engaged on path to net zero. I mean, again, with the view that this is a financial risk where we're investing, we're looking to engage with companies to make sure they are addressing it. And where they're not, we will potentially vote against. More generally, and it's fascinating to me. So if you take Larry Fink, the chairman, chief executive, his diary, and I've been on many trips with him, and we were in the Middle East last week as an example. It would typically be full of meeting big clients, the sovereign wealth funds, the insurance companies, the pension funds, and talking about portfolio construction, all the above, capital allocation. His diary has shifted to where he's meeting, basically the CEOs and CFOs and chairmen of the major corporations of the world who are represented in the room here today. And I'm sitting in a lot of those meetings. And I think the first thing we're doing is we're engaged in trying to understand the challenges corporations are facing, because BlackRock has a big voice.
Yes.
And Larry's prepared to use it. And so understanding the issue. So as an example, one of the big messages we're getting from companies, particularly those in the energy and power complex, is markets not rewarding us for what we're doing.
Right.
Okay? And it's not, how does it distinguish between us who's actually engaged on addressing this risk and this challenge as against those that are not? And I think the other key issue that's flowing and not unrelated to that is we're in transition.
Right.
And it's not black and white. And what we're seeing is this major shift in capital, which is taking away much needed capital for things we still need. And we're seeing that play out in, obviously, natural gas and oil prices. Big discussion last week in the Middle East is where are we with excess oil supply capacity, and big concerns about where that supply-demand balance is towards the back end of next year into 23 and beyond. And the price response to that could be a lot sooner. Because if we don't keep energy as it is, we don't have security of supply and don't have a fair price of supply, then that's going to create significant macroeconomic negative issues, inflation and growth, which in turn will undermine actually the need for transition. And so the first is we're engaged on these issues with a view to looking to influence capital and policymakers around what needs to be done. But the second thing is we have $9.5 trillion, and so we have capital across the spectrum, and so very much engaged in working with corporates around transactions, capital, etc. And so in my role as CIO of the alts business, I actually have the capital market function for Blackrock reporting into me, which is about $250 billion a year of flow. So it's basically 1-800-BlackRock, I need capital. But it's, so very much focused on that. But look, I mean, I describe BlackRock as like a candy store of capability and competence, if you can only imagine it, at the macro level, at the sector level, at the corporate level. And so we can also bring that to bear to work with companies around key issues they may have, strategic or tactical. But it's an interesting time, and it's a very dynamic time.
Perfect place to end it. It's an interesting time. It's a very dynamic time, and there's a lot of opportunity. So thank you very much. I know your time is incredibly valuable.
I think I'd have preferred his $4 billion, by the way, than my $320 billion. I'm just saying.
It's okay. It's all good.
Yeah.
So thank you so much. We really appreciate it, Jim. We're going to turn it over.